Imagine this. A 30-year-old software company decides to bet everything, and I mean everything, on Bitcoin. They buy so much of it, they end up holding over 3% of all the Bitcoin that will ever exist. But what happens when that massive bet puts them on a collision course with the old-school rules of finance, threatening a $9 billion collapse practically overnight? Yeah, let's get into it. So, the date is November 21st, 2025, and the bottom is falling out of the market. In just one day, Bitcoin's price absolutely craters, plunging by more than $7,000. Panic is everywhere. But for one company, this wasn't just a really bad day at the office, this was a potential doomsday scenario.
So you have to be asking, how can a single price drop possibly threaten a company that's sitting on a crypto fortune worth tens of billions of dollars? Well, the answer is a wild story. It's a high-wire act of insane leverage, unwavering belief, and one little-known rule that almost brought the entire thing crashing down.
Okay, to really get why this was such a crisis, we've got to rewind a little and see how we even got here. Because, this wasn't some flashy crypto startup. This was the radical, maybe even crazy, transformation of an established tech giant. And the scale of this pivot is just, it's kind of hard to wrap your head around. For 30 years, MicroStrategy was this super stable, successful software company. Fortune 500 clients, the whole deal. But then, starting in 2020, they took a hard left turn. So hard that by 2025, a mind-boggling 77% of the company's entire value was in Bitcoin. They weren't just a software company anymore. They were basically a publicly traded bet on a single crypto asset. And this whole audacious gamble, it was pretty much driven by one man, the founder, Michael Saylor. See, after all the money printing that happened back in 2020, Saylor got really worried about the value of regular currency, the dollar, just going down the drain. He became totally convinced that Bitcoin was the only real safe place to put money, the ultimate digital gold. And he staked his entire company's future on that belief.
But here's the thing. Saylor didn't just buy a little Bitcoin to diversify. Oh no. He built a machine designed for one single purpose, to accumulate as much Bitcoin as humanly possible. And the model was, honestly, beautifully simple and incredibly aggressive. Step 1, raise a ton of cash by selling new company stock and taking on high-interest debt. Step 2, take every single penny of that cash and buy Bitcoin. And step 3, you guessed it, repeat over and over and over again. It was like a perpetual motion machine for buying crypto.
And the results were just staggering. By November of 2025, this machine had scooped up almost 650,000 Bitcoin. Now let that sink in for a second. That's over 3% of all the Bitcoin that will ever exist. Ever. All sitting on one company's balance sheet.
I mean, just look at this. This chart tells the whole story. The transformation was total. The company's original software business, its entire identity for decades, was now just a tiny sliver of its value. For all intents and purposes, MicroStrategy had become a Bitcoin fund that just so happened to sell some software on the side.
But here's the catch. There's always a catch, right? This strategy was not free. To fund this massive buying spree, the company took on a mountain of debt. We're talking more than $185 million in interest payments every single year. That's a huge bill that has to be paid in cold, hard cash, whether Bitcoin is flying to the moon or crashing to Earth. And that risk is what set the stage for this whole crisis. And this, right here, brings us to the moment it all came to a head. The moment where MicroStrategy's wild crypto experiment collided head-on with the very rigid, very unforgiving rules of the traditional financial world.
Now, to understand the threat, you need to know about something called the MSCI. It's one of the most important stock indexes in the world. Trillions of dollars in big passive funds, we're talking pension funds, retirement accounts, ETFs, they all automatically buy stocks just because they're on an MSCI list. Being in that club is a very, very big deal.
And here is the rule that became a ticking time bomb. Buried in the MSCI rulebook is this little provision that says if a company's crypto holdings cross a 50% red line, meaning they make up more than half its value, it can get kicked out of the index. Well, at 77% Bitcoin, MicroStrategy hadn't just crossed the line, they had lapped it.
So, what's the big deal if they get kicked out? Well, Goldman Sachs did the math. They figured that all those passive funds would be forced to sell their MicroStrategy stock immediately. And the total amount of that forced selling? A colossal $9 billion. An outflow like that doesn't just hurt a stock, it can trigger a complete death spiral. And yet,
Even with this $9 billion sword hanging over the company's head, Michael Saylor's public confidence never cracked. Not once. Just a few months before this all went down, he was on record predicting Bitcoin would hit $1 million. For him, this wasn't some short-term gamble. It was the long-term end game.
Of course, on the other side, you had vocal critics like economist Peter Schiff. He was calling the whole thing a fraud, a Ponzi scheme, and was predicting that all the debt would cause an inevitable collapse. So by late 2025, the entire market was just holding its breath, waiting to see who was going to be right.
So as the decision day got closer, the whole financial world was watching. Was MicroStrategy about to get hit with a $9 billion liquidation event? The answer finally came, but it wasn't the clean win that a lot of people were hoping for.
The news broke in January 2026. MicroStrategy was staying in the index. And you could almost hear this collective sigh of relief from the market. The catastrophic $9 billion sell-off was off the table. But buried deep in the fine print was a catch. A really subtle change that would completely alter the company's master plan.
And here's the crucial detail, so listen close. MSCI said, okay, you can stay, but we're freezing your share count for our calculations. Now what that did was it cut the power cord on their growth engine. Before, whenever MicroStrategy created new stock to buy more Bitcoin, all those big index funds had to buy it to stay balanced. It was a guaranteed customer who didn't care about price. That mechanism, what some people call the infinite money loop, was now officially broken.
So, the game had changed. They survived, sure, but their primary engine for growth had just been shut down. Now, for any normal company, this would be a back-to-the-drawing-board moment. But as we've learned, MicroStrategy is not a normal company.
And their very next move tells you everything you need to know. Right after the MSCI decision, like literally in the days that followed, what did they do? They went right back to the playbook. They raised another $1 billion and bought another 13,000 Bitcoin, paying over $91,000 a coin this time. The message couldn't have been clearer. Nothing has changed. We're not stopping.
And that's when you realize that for Saylor, this vision is way bigger than just stacking up Bitcoin. He sees it as the bedrock for a whole new financial system he calls digital credit. He actually believes that Bitcoin-backed assets can replace the entire traditional banking system. For him, accumulating all this Bitcoin isn't the end game. It's just step one.
And that leaves us with the ultimate question, doesn't it? Is this unwavering, all-in, high-leverage bet the blueprint for a revolutionary new financial future? Or is it a spectacular cautionary tale, a story of incredible conviction whose final, maybe painful chapter just hasn't been written yet? For now, the gamble continues.